OD Jacob here. Today we're looking at applied industrial technologies in the trading companies and distributors industry. 7.3 billion market cap on just under 7.5 billion enterprise value. They distribute industrial motion, power, control, and automation technology solutions really globally. So growth has been probably averaging mid single digits year over year, 2.46 billion to 4.44 billion, 4.4 billion. Gross margin and operating margin both increased, so that's a positive. Dividend growth, pretty consistent increases. Return on invested capital recently in the upper teens, historically still probably averaging low double digits, so all positive stuff there. Balance sheet shows 344 million cash-like products with 597 million long-term debt, with just 25 million short-term debt. Let's say round up 600 million. That 600 million in relation to their 5-year average free cash flow is less than 3 years. So really no concern from the balance sheet perspective. Good production of free cash flow. Not a lot of capital expenditures, which means that it doesn't take a lot to keep the business running. But that also means that they're not necessarily reinvesting a whole lot back into themselves. You can see that the use of cash flow is, they're really using all avenues. So they're making acquisitions with maybe 15 to 20% of their free cash flow, paying down debt with quite a bit of it. Their dividend is using about 25%, and then share repurchases maybe 10 to 15%. So they're really using all their hands to pay back shares, pay dividend, pay down debt, make acquisitions. They're really just not reinvesting back in themselves, at least not enough to really make a dent on capital expenditures or not. But I mean, they're growing, so they're definitely doing something right. If we're ready to make some assumptions here, I would say that I probably wouldn't be surprised with maybe something like a 5% growth rate. And then for margins, they have been going up. I do like that free cash flow is greater. Maybe we'll do 6 and 7. Share change, 1% would be about 73 million. And they're not doing that. Let's say they offset stock-based compensation, essentially. Terminal PE on 5% growth rate, still double-digit return on invested capital. Let's put in 16 here, 16, 15% return. Dividend, let's grow that, because their payout right now is just about 25%. So let's increase that with their revenue growth. Okay, and that gets us to a stock price that needs to fall 65% before you get the return we're looking for here. So, yeah, I mean, I do think that we do have a good company here. I would definitely add this to a list of possible things to buy. But again, every investment's present value of earnings and free cash flow. And here, I just think that the price is a little frothy compared to my assumptions for sure. But I do hope you enjoy the video and have a great rest of your day.